Let's get to Disney. Stock is surging this morning after narrowly beating estimates on the top and the bottom line. Streaming boosting the entertainment unit. Also says profit will increase for the next 3 years. Michael Morris joins us this morning. Guggenheim Securities analyst, has a buy rating and a target of 110. Although, Michael, with this reaction to earnings, which I think is the biggest earnings gap higher in a couple of decades, does your target change?
Well, I can't really talk about whether the target will change or not, but what I will point out is that, number one, I think the most important takeaway from this call was management providing multi-year guidance for earnings, which shows a lot of confidence that they have in their visibility into the model. We can talk about that more, but when you look at what that guidance implies for earnings growth relative to where consensus was and where we were prior to this print, you can see that we were below what the company is now guiding to, so we look at that favorably.
The other thing we were talking about this morning with Jim and David was Hugh Johnston's point on Squawk that the business mix he's very happy with. Linear doesn't seem to be an orphan you need to spin away. Does that make Disney the cleanest model to evaluate right now in media?
Well, it's a tough to answer that. I don't know if I call it the cleanest just because it does have such a diversity of assets. So there are challenges. One of the things you and I've spoken about in the past is that the parks was always this part of the business that investors could depend on as being solid, and that was called into question over the last couple of quarters with some concerns about the consumer. So I don't know if I would say cleanest. However, we do agree with the comments that Hugh made earlier today about the asset base. We've long believed that companies like Disney that have very strong content bases and intellectual property bases don't need to divest old media. They just need to make sure that they're using every different window they have to reach the consumer in the most effective way, both for current monetization but also for future growth.
What about sports? Flat numbers there. Was that a weak spot? And how much should investors be paying attention to it?
Well, I think sports is very important for the business. The company has made what I think is a very compelling point about sports. First of all, I think that there's some complication in the company's results with respect to sports in the U.S. and sports outside of the U.S., which has been a bit more of a drag on the business than the health of the ESPN business as we know it in the U.S. But when we look forward and think about what the growth potential of this company is, that sports asset is a big part of that, and that really is centered on this ESPN flagship product that is scheduled to launch in fall of 2025. That is a standalone streaming ESPN product that we think will help broaden the company's ability, again, to reach consumers. Remember, at this point, roughly half the homes in the U.S. have pay TV, which means roughly half the homes can get ESPN. There's another large group of people out there who are broadband-only subscribers who would like to subscribe to a service if they could just get that. And we're excited that Disney's going to meet them there. And Disney's also looking at ways to combine that ESPN product with the Disney streaming product. And that type of bundle is an asset to a company that has this diversity of content.
When it comes to parks, we're in a tape this morning, Michael, where the airlines are doing well. Barclays upgrades a couple of them, raises targets. They think next year the environment around travel is going to do well. We got some new investors in Wynn, so casinos are doing all right. What's your feeling about parks and experiences in 25?
Well, I feel very good about parks. So just taking a step back, I would say we've been bullish on this company, and we felt that investors had become overly negative on this parks dynamic because we were seeing really healthy trends in travel outside of this company, and we just struggled to understand how this would be the one company that would underperform on travel trends relative to everything else that we're seeing. So I think the guidance that they just gave provided a couple of areas of comfort. One, they grew this quarter on the domestic business, even when they had some incremental investments and there was concerns about the consumer. The attendance was flat, but they still have a lot of pricing power. Two, they guided to pretty healthy growth, mid to high single digit on operating profit in the coming year, even as they are investing in some of these new cruise ships. And three, there has been concern about competition. Comcast is opening a very large park in Orlando in May of 2025, and the company addressed on their earnings call that was incorporated in the way they were thinking about the coming year. So I think they did a great job both of addressing some of the concerns and also showing some strength.